Welcome. Today we're diving into a crucial yet often overlooked concept in investing, value at risk, or VaR. It's a key tool for managing market risk. Whenever we invest in the stock market, the conversation is often dominated by potential returns and gains. We talk a lot about what we might earn, but very rarely do we quantify the downside or the risk involved. This lack of quantification can be a significant gap. That's where value at risk, or VaR, comes in. It's a sophisticated metric designed to bring clarity to market risk. VaR provides a structured way to look at market exposure. But how exactly does it work? VaR answers one simple but powerful question. What is the maximum loss I can expect over a given time period at a given confidence level under normal market conditions? The definition highlights three key components: the time frame, the confidence level, like 95%, and the crucial assumption of normal market conditions. Let me explain this with a real example to make the calculation more concrete and easier to understand. Suppose I invest in Infosys, 500 shares at a price of 1,615 rupees and 40 paise. That totals an investment of about 8.07 lakh rupees. Using 10 years of historical price data, I applied the Parametric VaR method at a 95% confidence level for a 10-day holding period. So what was the result of this calculation, and how do we interpret that figure? The resulting 10-day VaR for this Infosys investment comes out to 83,094 rupees. What this means is that there is a 95% probability that the loss on this investment over the next 10 days will not exceed 83,094 rupees. Conversely, it also implies there is a 5% chance that actual losses could be higher than this calculated 83,094 rupees. The true value of VaR lies in its practical application for risk management and decision-making. VaR is extremely useful because it converts abstract market risk into a single, concrete rupee figure. This simplicity makes it easier for investors, analysts, and decision-makers to set risk limits, efficiently allocate capital, and compare risk profiles across different portfolios. While VaR is a powerful tool, it's not without its limitations, and it should always be used as part of a comprehensive strategy. VaR does not tell us how severe losses can be beyond the calculated level, and crucially, it assumes markets behave normally, which we know is not always true during crises. That's why VaR should be used along with other risk measures, such as stress testing, to account for extreme, non-normal market scenarios. Risk cannot be eliminated, but it can be measured, managed, and prepared for, and value at risk is one of the most practical tools to help you do just that. Thanks for watching. Stay tuned for more.